Good afternoon, and thank you for joining the Westwood Salient MLP and Energy Infrastructure Fund quarterly update call. I'm Addison All, Product Manager at Westwood. As a reminder, this call is intended for financial professionals only. If you're not a financial professional, please disconnect your line at this time. Today's call is also being recorded. We are joined today by Greg Reed, President of Real Assets and Head of our Energy Infrastructure business, Ted Garner, Senior Vice President and Senior Portfolio Manager, and Parag Sangani, Senior Vice President and Senior Portfolio Manager. Today's call will review the current market environment, our sector outlook, and the mutual fund's second quarter performance. Today's presentation is a Zoom webinar, and the presentation video will be emailed to participants. The Q&A portion is web-based, so please send those questions to us using the Q&A tool on the bottom of your screen. The chat box has also been disabled for this call, so please do not use that function. We will do our best to answer all questions, but should your question not get answered, please feel free to reach out to us at 1-800-994-0755. And before I introduce our first speaker, please take a brief moment to look at the required disclosure that is shown on the screen. Okay, and with that, I'd like to turn the call over to our first speaker, Greg Reed. Greg, kick it off for us.
Thank you, Addison. Thank you all for joining this afternoon. Hope you're having a great summer and a very good year to date so far. We are certainly enjoying the year to date. It's been a strong year for midstream energy infrastructure. The index is up about 22%, as is our fund year to date. So an excellent year. And 2Q was up about 6.6%. So very strong 2Q. As we normally like to do, we like to kind of review the highlights from the quarter. And so just going through April, two big pieces of news: Enterprise Products, which reported earnings this morning, a good inline quarter, did receive their deepwater port license for an oil export terminal called SPOT. That's now a live project that they're out looking for customer demand. And secondly, and probably more importantly, Kinder Morgan kind of sparked the AI discussion and the demand from data center growth for natural gas in their April first quarter call. And many companies that are involved in natural gas pipelining talked about increased demand for natural gas coming from data center growth that has become kind of a hot topic in the space since April. Moving into May, the big news really was Energy Transfer doing a large acquisition for $3.25 billion. Today, these deals are getting done at pretty reasonable multiples in the 6 to 7.5 times EBITDA range, with the stocks trading higher. And so we're seeing minimal equity issuance and nice accretion on deals like this. So good to see more of those in the future, particularly buying private assets that are basically, at their monetization stage from private equity backing. And then in June, two pieces of news really. TC Energy up in Canada received shareholder approval to spin off their liquids business from their natural gas business. That'll create two different tickers. That's unlocked some value in TC Energy, which has underperformed a lot this year, providing a new catalyst for the stock. And then probably more importantly, Cheniere Energy updated their 2020 Vision capital allocation plan, and they increased their share buyback by a huge $4 billion and raised their dividend by 15%. So that really helped propel that stock, which had been underperforming most of the year, to make it basically perform better here in the last 30 to 45 days. So all in all, it was a great month, up over a great quarter, rather, up over 6%. And we're getting some questions about, where are we in the cycle? We did this slide to try to show that energy, in particular, and midstream energy, has historically been kind of a long cycle business, 7 to 10 year type cycles. The bull market back in the 05 to 14 period lasted about 10 years. That was a high growth phase where the U.S. grew production substantially due to hydraulic fracking and horizontal drilling. Then we had, unfortunately, a pretty painful 5.5 year bear market that really didn't end until COVID brought that to an abrupt ending. The companies reacted positively to that, large drawdown and cut dividends and pay down debt and basically shore up their balance sheet and change their strategy to one focused on capital discipline, returning cash to shareholders through dividends and share repurchases. And that has ignited a new bull market that's lasted about 4 years now. We think we're in a mid-cycle phase, and that is because the companies themselves are at a very healthy point with lower than normal leverage, and many of those companies have achieved their leverage goals. They're also growing their dividends on average about 5%. And those two things have basically helped the share price volatility decline and drive higher returns. And that has attracted some generalist investors who are now taking a fresh look at the space. Before, one of the concerns was, commodity price volatility and leverage led to higher share price volatility. Now we thankfully have kind of entered a new phase where the companies are very disciplined on leverage and frankly are growing at very reasonable rates and therefore have a lot of excess cash flow they don't need for CapEx to return to shareholders. And so we think that is a very good place to be. And our belief is that these companies will not change their strategy. It's working well. Capital discipline is what investors wanted to see from energy companies, some of whom weren't good stewards during the bear market phase. And so we think a lot of that has been fixed, and we're in a very healthy environment today. In terms of valuation, we basically, after suffering a very large, drawdown in COVID in 2020, kind of artificial drawdown in oil prices that went negative, we basically recovered from 9 times EBITDA in 2020 up to about 10 times today. This is for the AM&A broad index using a Bloomberg calculation. And that's about 10% below where it was in 2019 prior to COVID. So we have recovered some of the multiple contraction, but we're not fully back there yet. And I'll show you in a few minutes here that we're actually about 20% below the 10-year average. And so we do think there's some multiple expansion potential ahead of us. And that's why, we say we're probably in a mid-cycle phase, maybe akin to the 4th or 5th inning of a baseball game. We don't think we're near the end of it, but we're not obviously in the first inning either. In terms of 2Q earnings, we've seen a couple reports. Enterprise this morning, Kinder Morgan last week, and then DTM was this morning as well. What we expect the majority of the companies are going to say is that volumes rebounded in 2Q following some weather anomalies in 1Q. Balance sheets are largely in great shape, having been repaired over the last 3 or 4 years. And so investors are keen to understand, how are you going to return all this free cash flow to us? Are you going to increase the dividend more? Are you going to buy back shares? Or are you going to begin spending, more on CapEx? And the right answer, honestly, is that they should increase dividends and buy back shares and really not try to increase CapEx much so that they maintain their discipline. We also think we'll see some companies update their guidance because we're at the mid-year point, and if they're seeing some differences in their full year guidance, now's a good time to kind of adjust that for the balance of the year. One of the big topics and newer topics, really going back to Kinder's April conference call, was the increased demand for natural gas from the data center growth that is largely being driven by artificial intelligence. The computer power is obviously significantly higher with NVIDIA chips, and the data center opportunity to build out higher data center capacity and much larger facilities is creating more demand for natural gas. This is a longer term trend that many people are trying to predict, what will this look like over the next 5 or 6 years. It's still early days, but it does look like data center usage of electricity will grow from about 11 gigawatts up to somewhere between 40 and 94 gigawatts by 2030. So quite a substantial amount of growth here. That will likely lead to natural gas demand growth from 3 BCF per day upward to at least double, if not all the way up to the higher end of the range, which people are estimating could be as high as 16 BCF per day. Goldman Sachs, for example, is saying incremental gas demand require about 6.1 BCF per day of pipeline capacity. So to quantify that, that would be about 7.4 billion of CapEx. Now that would be spread over a couple of years. So at the end of the day, it's not a huge amount of CapEx, but it does create incremental demand for gas. And that nicely pairs with the LNG demand for gas that we're going to talk about a little bit later. So Kinder Morgan kind of got this discussion started in April. It's continuing, and many companies that are involved in the gas business today are talking about seeing demand from their customers to put in place greater capacity to deliver more natural gas to their customers for data center growth and other uses of natural gas here in the U.S. Now, in terms of trying to quantify this, excuse me, natural gas demand is poised to grow. Sorry about that. Hit a little air pocket in my throat. We can say that the natural gas companies like Kinder, Williams, and DTM and TRP are the most likely to benefit from this incremental demand. But other companies like Energy Transfer do have pretty substantial businesses in natural gas pipelines. So this does look like it could drive, kind of a base case estimate, a 7 BCF per day growth just from the data center element of it. And there are some estimates as high as 16 BCF per day that we're seeing. So it's still pretty early. These projects have to be, commissioned, announced, and delivered, but it does look like it's a new promising growth area for midstream energy. And that ties in very nicely with the LNG demand growth that we're seeing over the rest of this decade. The mega themes are basically the same we've been talking about. Hydrocarbons, we believe, have a long future, i.e. to 2050 or beyond. There is an opportunity in energy evolution for other forms of energy like renewables, but the midstream opportunity set, we do think, does have a lot of future, and LNG export growth is certainly something that's a key driver for demand. In terms of our cornerstones, they're pretty consistent over time. We're in a phase now, a mid-cycle phase, where we're really harvesting free cash flow, kind of like a manufacturing business. That is pretty prevalent across the space. Companies have largely met their leverage targets. Some have not, like Enbridge and TRP, but most companies have now reached their leverage targets they set back in the 2020 COVID era. And so the companies have more wherewithal to increase dividends and to buy back shares. So our outlook right now is for EBITDA growth of 4 to 6% over the next couple of years, and dividend growth of about 5%. So for example, Enterprise Products had their quarterly call this morning. They grew their dividend exactly 5% over the previous 12 months. And so that is kind of the baseline dividend growth estimate we have for our space. And where that leads us is the companies have now started a multiple expansion opportunity. Time will tell how much expansion we might get. But after COVID, there was a lot of contraction, and companies have now rebounded, and it does look like there's some room to see multiples expand, potentially 10 to 15% from here. At the same time, and with very strong returns, we unfortunately still see many investors, on the sidelines because of ESG issues. Institutional equity is not really allocating new dollars. A lot of the investors that are in the space are very pleased to see the returns. But just given the ESG concerns by consultants and many investors institutionally, there's not a lot of new capital coming into the space. So the positive silver lining there is that returns remain high because valuations are most likely depressed given the lack of new capital coming in. So it's not a bad place to be. As an asset manager, of course, we'd like to see more new asset flows, but at the end of the day, returns that we're seeing in the double-digit area are certainly attractive for investors. And we are seeing some new demand from traditional allocators that are looking at energy for the first time or re-looking at it again after, perhaps cutting their allocation in years back. So in terms of where we sit on CapEx, this is a slide that shows that we are basically in a fairly flat CapEx environment. We're seeing investments in the $34 billion range for last year and this year, and most likely for next year. We think that's likely to remain, fairly flat and maybe even decline in the years ahead, translating into more free cash flow for the industry. And this is a way to kind of quantify that. 2022, as you can see, was kind of a record free cash flow year. That was really an anomaly because of the Russian attack on Ukraine. We had an above market, above year performance in 2022 with elevated oil and gas as well as natural gas and NGL prices. Things have kind of stabilized and normalized here in 23 and 24, but we're in the 6 to 6.5% free cash flow range. The yield of the index right now is about 5.7. And so companies have, about 0.5% available to raise dividends or do share buybacks. As time moves on and companies no longer want to pay down any leverage, they have more wherewithal to increase dividends. And so we think that free cash flow will likely trend higher, 7, 8, and perhaps even 9% as we move forward. Excuse me. So as we look at the capital allocation in percentages and dollars, you can see that leverage is being paid down at about $5.4 billion today. That's largely coming from two of the Canadian companies, TRP and Enbridge, that are still over-levered by our standards and midstream standards. Most companies have hit their leverage target, and so what we'll likely see is, by our calculation, about a 30% growth in cash flow being returned to shareholders over the next 3 to 5 years. That comes from pretty stable dividend growth there, about $43 billion in dividends this year, growing to about $50 billion by 2028. And the big driver in terms of year-over-year growth is really share buybacks. Those could probably double from about $4.5 billion today to about $10 billion in 2028. So overall, companies are going to be returning a lot more cash to investors. And one of the options they have, and most companies have actually implemented a share buyback plan today. About 73% of the companies in our universe have approved share buyback plans in place. In terms of coverage, we're seeing very stable coverage around 1.8 times the dividend or distribution. As some of you may remember, a decade ago, that was substantially different. Looking back at 2014, you can see coverage then was only 1.2 times the dividend. So we're in a completely different world now. Companies are now covering, 180%, 190%. So the model has really completely changed from where it was just about a decade ago. And the debt to EBITDA this year is poised to drop below 4 times to about 3.8 times debt to EBITDA by the end of this year. And we think that's probably a pretty comfortable place to stabilize around 3.5 times debt to EBITDA. Enterprise reported this morning, and they're basically using a 3 times debt to EBITDA target, and they're already at that target level today. So they're really under-levered relative to the average company in our space. Moving on to valuations, you can see here, this is the average company compared to the index valuation. That's why the numbers are a little bit different here. The average MLP only trades at 8.5 times EBITDA. That is about 6% higher than the 5-year average, which includes that really depressed COVID year in 2020. Compared to a 10-year average number, the valuations are about 18% below average, and midstream C Corps, which are about 70% of the universe, are trading at 9.4 times. That's also about a 20% discount to the 10-year average. And so from our point of view, if we sit here at mid-cycle, there is an opportunity over the next 4 or 5 years, we think, to recover that discount that we trade at relative to the 10-year averages. And so there could be potentially, 10 to 15, even 20% revaluation potential to get back up to that 10-year average over the full cycle of the decade. In terms of the other major growth driver that we've talked about, for the last couple of years is LNG capacity. As a reminder, the U.S. is the largest global exporter of LNG to the world, and we're expecting with a number of projects coming online over the next 3 years that we'll see about 44% growth in U.S. LNG export capacity, most of which is happening here on the Gulf Coast in Texas and Louisiana. So that's a substantial amount of capacity that's being built that will be coming online. And that's that's a pretty significant driver for natural gas pricing, which has firmed up a lot after some really significant weakness below $2 per MCF earlier this year. Prices have recovered, and that is creating, more longer term demand out in the 2 or 3 year period. So in terms of trying to show what the impact is in the Permian, for example, we think that natural gas supply will grow about 40% over the next 5 or 6 years, from about 18.5 BCF per day to about 26 BCF per day. Currently, LNG demand is around 12 BCF per day in 2023. We think that will probably grow up toward 26 BCF per day, which is more than double over the next 6 years. And so that is clearly a significant growth driver for the industry. And we think that is going to be one of the major drivers, along with the data center growth that we're seeing for natural gas, that should lead to substantially more demand for natural gas over the balance of this decade. And so kind of wrapping up, we talk about consolidation typically. 2 of the deals that we've been talking about closed. NuStar closed back in May. That was acquired by Sunoco, an energy transfer company. And then just a couple of weeks ago, Equitrans was acquired by EQT, a gas producer, that closed on July 22nd. So at this point, there are no pending deals. There is one potential deal, Hess Midstream, that if the Hess acquisition by Chevron does go through, we would expect Chevron would likely go ahead and buy in Hess Midstream, 6 to 12 months after that deal closes. They've done this before with Noble Midstream. And so that's kind of the one potential situation. But there could be others here on this list that are small to mid-cap companies that, probably deserve or belong better in a large cap company over time. And so there could be some continued acquisition activity, in the space going forward. And then kind of wrapping up here, key risks, which we'll talk a little bit more in the Q&A, I'm sure. But, certainly there's always risk of commodity prices going lower. They're in a very nice, trading range now with oil in the mid-70s. Demand destruction would largely come through a recession, which doesn't look that likely. So probably the bigger risk is, if there was some, commodity price shock from OPEC, that could upset the apple cart. OPEC is nicely subsidizing the crude oil volume. And so it does look like we have a pretty nice situation today with OPEC, subsidizing and not putting extra barrels on the market. And then kind of the big topic I'm sure will come up over the course of the call is geopolitics. What's going to happen with the U.S. election, and how long will these 2 wars, go on in Russia and Israel. So with that, I'm going to turn the ball over to Parag Sangani to talk about the portfolio and the attribution for the year.
Thanks, Greg. On page 26, you can see the different share classes listed there. The institutional shares actually had a good second quarter. The mutual fund was up about 6.6% compared to the index up 6.2%. For the year to date, basically the mutual fund is in line with the AMEI index, up 18.93% versus 18.91% for the index. In terms of sector allocations on page 27, if we look at where the portfolio is today, there hasn't been a lot of change during the second quarter. We remain pretty well allocated across the sectors. with the focus primarily, like what we like to say is we're 80% not oil. As of the end of the quarter, we were actually closer to about 78% not oil. But we did have a heavy weighting in gathering and processing companies at about 25%, and then NGL infrastructure at just shy of 28%, followed by crude and refined products infrastructure at about 21.5%. Looking at the top 10 holdings, last quarter we had quite a bit of concentration in the top 10 holdings, driven by an increase in Kinetic. And in this quarter, what we've seen is really not a lot of change, but we did have a couple of small shifts. First, there was an equity offering for Hess Midstream during the quarter by an existing holder of the stock. And so we were able to purchase that at a discount, and we actually did buy quite a bit of that. So at the end of the quarter, Hess Midstream was our 8th largest position in the portfolio, and it bumped into the top 10 holdings. From a standpoint of companies that came out of the top 10 is Equitrans on page 28. Equitrans got acquired by EQT, as Greg had mentioned, and so that position was sold down at the end of the, or by the end of the quarter, I should say. In terms of overall concentration, at the end of the second quarter, we were close to about 73% in the top 10 holdings, and that amount we knew was pretty well concentrated. It was driven by our purchase at the time of Kinetic. We've trimmed that position back. And at the end of the quarter, Kinetic, which was about a 9% weight at the end of the second quarter, sorry, excuse me, at the end of the first quarter, ended about 4.5% weight at the end of the second quarter. Also, the broadening that we've seen overall in the industry over the last 4 to 6 months gave us a lot more confidence to own some of the more mid-cap companies in the space, and we upsized names like Antero Midstream and EnLink in that process. Going on to page 29, contribution by sector just really was driven by what we had overweight in the portfolio. So gathering and processing, our largest positive contributor at a 25.5% average weight, contributed 277 basis points of portfolio performance for the quarter, followed by NGL infrastructure contributing 138 basis points, and then crude and refined products contributing 132 basis points. Second quarter was really good overall. We had actually 0 sectors detract from a contribution standpoint for the portfolio. So across the board, all the sectors were positive. On page 30, really focused on attribution. How did the fund do relative to the index? Crude and refined products, we were overweight, really driven by our overweight in Plains All American. And by being overweight into a rising oil price environment, we think that that helped contribute to the positive attribution for the quarter. The crude and refined products subsector added 66 basis points of alpha during the quarter. Being underweight natural gas pipelines, which at a subsector level, we're underweight, but reality was that we had an underweight in TRP, TC Energy, and that drove positive attribution of about 19 basis points. And then being overweight gathering and processing added 17 basis points during the quarter. In terms of detractors, there weren't any real meaningful detractors during the quarter from an attribution standpoint. And on page 31, top performers or top contributors by company, Targa Resources had a very strong second quarter, provided 81 basis points of contribution to the fund. The story on Targa really was a first quarter story. In the first quarter, they announced that they're going to slow down capital spending. So CapEx is going to decline right around $1 billion year over year in 25. And at the same time, they're going to see about 10% growth on their EBITDA. So they're going to see cash flows grow right around $400 million a year. And that delta, that 1.4 million, is translating into a significant ramp in free cash flow at the company. And so we've seen a meaningful re-rating of the stock. Genesis, our second best contributor during the quarter, was up about 28.5% during the quarter and contributed 68 basis points. Genesis has really been a CapEx story. They've been spending a lot of money on building out their soda ash infrastructure and expanding their facility. That capital spending program is slowly winding down here over the next few months, while cash flows are expected to ramp over the next 12 to 18 months. So Genesis is at the early stages of what Targa just went through, where they're starting to see their CapEx begin to decline and cash flows start to actually ramp. So we think that as we look forward into 2025, Genesis could see a meaningful inflection in free cash flow generation. And we continue to hold the position at a sizable overweight relative to the index. In terms of detractors for the quarter, just looking at the top two detractors, it really was Enbridge and TC Energy. Both of them were down a little bit during the quarter. Small weights were underweight relative to the index, but we did have a small weight in both companies, detracting about 5 basis points each to the portfolio. Attribution for the quarter, Genesis was the single largest positive attributor on page 32. Being overweight 2% versus about 0.5% for the index resulted in 44 basis points of positive alpha for the quarter, followed by the underweight in TC Energy at 3% versus about 4.5% in the index, generated about 29 basis points of positive alpha for the quarter. In terms of detractors, we were underweight DT Midstream. That's one that's talked about as being a winner in the AI trade. We felt that this company was trading close to fair value. They have a lot of northern Louisiana Haynesville exposure. And with low natural gas prices, we're concerned that Haynesville volumes could potentially negatively impact the company. And by being underweight, that did detract from an attribution standpoint, 46 basis points from the overall alpha in the portfolio. And then finally, being slightly underweight Williams for the quarter on average detracted 16 basis points during the quarter. Looking at it on a year-to-date basis, contribution on page 33, again, our largest allocations by subsector are really what are driving the portfolio: gathering and processing, NGL infrastructure, and crude and refined products, all contributed nicely to the year-to-date performance in the mutual fund. The one detractor for the year is earlier this year in January, we were expecting a tax loss rebound for renewable names. And so we did take a small position in renewables. That didn't work, and we unwound that trade early in the year. But that did detract 66 basis points from the overall portfolio performance. Attribution by subsector on 34, gathering and processing overweight for the year really has been the biggest positive attributor, generating 129 basis points of positive alpha. That's predominantly kinetic, and I'll go into that in a little bit of detail on the individual names in a minute. Crude and refined products were slightly overweight. Really, it's being underweight Enbridge and overweight Plains, that combination that's been delivering a lot of that positive alpha, and that generated about 119 basis points of positive attribution. And then from a detraction standpoint, it really is the renewables bet that we took earlier this year detracted 73 basis points. And then Cheniere, which is our LNG exposure, detracted 35 basis points. In the last few weeks, we've seen Cheniere recapture some of that underperformance, but on a year-to-date basis, Cheniere has been a laggard. That's a name that we like for the long-term secular opportunity, and we continue to own it in size. For year-to-date contributors, for individual names, Targa has been the top contributor, up 40% on the year, generating 278 basis points of positive performance for the fund. And then followed by Energy Transfer. Energy Transfer is a name that we've had really as a top holding for well over a year now. A company continues to execute. They continue to keep increasing their dividend at a consistent pace. yet they're still trading at a meaningful discount compared to their peers. So we continue to believe that there's a lot of value in Energy Transfer, and the position was actually up more than the index this year, up 22.5% and contributed 245 basis points. In terms of detractors, it really was for the year-to-date basis, it really was the clean energy names. We saw Atlantic Sustainable Infrastructure and Enphase Energy being the two biggest detractors, detracting 14 basis points each. And then finally, attribution on a year-to-date basis. Kinetic was the single largest positive attributor. That's the one that we actually had an opportunity to buy late in the first quarter, and we bought it on an offering down a significant amount from the previous day's close, and then the stock has performed very well since. So the stock's up about 35%, 36% year to date, and it generated 116 basis points of positive alpha for the fund. And then being underweight Enbridge has generated about 100 basis points of positive alpha for the year for the mutual fund. In terms of detractors, we've same names again. Cheniere detracted 58 basis points, being overweight, has been a laggard on the year. However, we continue to remain very positively inclined for the secular long-term opportunity that Cheniere provides, and we continue to own it at an overweight in the portfolio. And then finally, DT Midstream being underweight for the year, with the stock up 27%, has detracted 53 basis points from overall alpha in the fund. And so with that, what I can do is hand it back over to Addison, and we can open it up to questions.
Great, Prog. Thanks for those insightful updates. Just as a reminder, if you do have a question, please use the Q&A button at the bottom of your screen. And while we wait for that, any other questions to come through, let's go ahead and start with a few questions that were emailed in ahead of the call from those that couldn't attend today. The first one is, can you explain how the tax treatment works on dividends and cap gains in the fund?
I can start there, and maybe Greg wants to add, but if you look at the mutual fund from a dividend standpoint, we pay out a quarterly dividend in the mutual fund, and over the last 12 years of the mutual fund life, we've seen the majority of that dividend has been treated as return of capital, and then a portion of it is treated as QDI, qualified dividend income, and then a portion of it is treated as ordinary gain. So there is a little bit of nuance in there, and it's difficult to predict what that will look like in advance to when that distribution actually comes out. But the good news has been that a lot of it is deferred over time. In fact, the majority of that distribution has been a deferred return of capital to investors since we launched the mutual fund. And in terms of capital gains, the great news about the mutual fund is that when we filed our annual filings a few months ago, we had over 900 million of tax loss carryforwards, and we have $1 billion mutual fund today from an AUM standpoint. So we don't envision there being any meaningful capital gains issues in the mutual fund anytime soon.
Great, good detail there, Parag. I did have a question while you were speaking just come through for the team, and that is, you all have spoken about the increased demand in the future. Is there outstanding pipeline and transition capacity to satisfy the demand, or does more need to be built?
Maybe Ted, you've got quite a bit of data on that.
Sure. So most of the production growth is coming out of the Permian. Greg showed the slide earlier where it showed it going from 18-ish to 26-ish BCF a day. Enterprise actually this morning on their call said that their number was more like 30 billion cubic feet a day going out to 2030. So and all of this is really kind of AI, growth, if you will, in addition to the LNG, which is already known when those come online. So the Permian's going to be, Permian and Haynesville are going to be the two that are most likely to supply the LNG side, and then we'll see multiple players depending on the geographic location of where they put the AI data centers. But a lot of it, we're going to have a lot of Permian growth, I guess is the point. And the way we think about it is about every other year, we probably need a 2 billion cubic feet a day pipeline to handle it, because gas has been and is tight coming out of West Texas. So there will be additional needs on that side, particularly in that area.
Appreciate that, Ted. I'll keep rolling along with the questions that were submitted. Next one is, can investors count on producers and pipelines to continue capital discipline and to prioritize shareholder returns?
I'll start on that. Simple answer is yes. I think it's ingrained, not just in the in the midstream side, but the upstream side. And that's really where it begins, quite frankly, because it's at the end of the day, the pipelines serve the producers as well as the downstream, refineries, utilities, and et cetera. So, and upstream has certainly found religion in focusing on returns on capital as opposed to growth. So, with that, up on the top of it, there's no need really for midstream to overspend. That does kind of lead into a question that we've gotten on the political side, like what does it, what if Trump comes into office and his drill baby drill, is that something that will cause these guys to lose that discipline? And we don't think so. Again, we think that they have been in the sweet spot. The industry, the sector overall is doing very, very well, with this newfound capital discipline and focus on returns. So we don't think that even with the Trump administration coming in and say drill baby drill, that they're going to do that. So I just think it's firmly ingrained at this point. I think they're all enjoying how their businesses are running, the investor reception, and the returns that they've experienced.
That was well said. I wanted to add, you can kind of see that in the rig count too. The rig count's down 10% year over year. There's been a lot of M&A activity, both in midstream as well as upstream. Exxon buying Pioneer, Chevron trying to buy Hess, and a number of others. So what normally happens when the E&P companies, get acquired is they basically, consolidate, lay off some people to cut costs, and drop rigs typically to become, the two combined are generally using more rigs than the survivor is going to do going forward. So at the end of the day, that kind of presents a picture of, some modest growth in production, but nothing out of the ordinary. And frankly, these companies learned a good lesson during the bear market that, focusing on production growth at the expense of profitability and share prices was a bad idea. And so we think now that they've kind of, like Ted said, found religion, if you will, what investors clearly are asking for is return of capital through dividends and share buybacks. If you look at earnings calls or listen to earnings calls like we do every day, if you announce a large increase in CapEx, your stock's typically going down. And so you're penalized right away if you surprise people with more spending. And so that's a quick reminder that you probably shouldn't do that, and stay focused on capital discipline. And, the message of returning cash to shareholders and letting them reallocate or reinvest back is the right message to send.
Thanks, Ted. Thanks, Greg. So we did have a couple more questions that were submitted via the Q&A tool. So I'll just go through those. The first one is, can you discuss the relative impact on midstream from anticipated energy policies under either a Trump or Harris administration? That's one that we've received a lot of, and obviously is a hot topic.
Yeah.
Sure. You want to go ahead, Brock? Go ahead.
I guess I'll start and Ted can finish off. But really, what we're looking at, capital discipline has been the name of the game, which Greg and Ted emphasized just a minute ago. But when we look at individual policies, what we've seen in the past is Republican administrations tend to be a little bit more beneficial from a regulatory standpoint. However, today, if we look at the biggest regulatory hurdles, they tend to be permitting issues that need legislation. So, regardless of which administration we get in federal government, we do need permitting reform. And then secondarily, there is a lot of the process, or a lot of the policies in place are also at the state level. And we do need reform to occur at state levels as well. That unfortunately will not be dictated by what happens in Washington. So we should see a good benefit from a Trump administration just from a regulatory standpoint. We saw when he came into office in 2016 that he worked hard to reduce some of the encumbrances towards getting pipelines built. We would expect similar actions again with him back in office. But from a larger perspective, to address AI, to actually get the infrastructure we need, we really do need a true permitting reform.
Good deal. Thanks, Parag. The other one was we mentioned M&A and a lot of the acquisition activity. What is that? What's the main kind of driver for that? What's the expected outcome or kind of the advantage? Is it to secure future drilling sites, or what's kind of the impetus for all the M&A activity in the space?
Yeah, it's been, I mean, for the most part, the companies are larger that are consolidating smaller players or mid-sized players. It's to basically secure additional, drilling locations and lengthen the runway and inventory. There's actually a very high correlation to stock price performance on inventory to drill and lengthening that runway. And to a lesser extent, I guess, majors are, some of the Exxon and Chevron are kind of de-emphasizing the very expensive, global projects in favor of doing more here in the U.S., bringing dollars back home. Those large scale projects have a lot of political risk, and there aren't as many of those being sanctioned. So there's some of that going on. And companies naturally might want to diversify their basin exposure. Some companies that are buying into a new basin through an acquisition to expand their basin activity. So there's some of that as well. So, but at the end of the day, we're seeing it midstream and certainly a lot of consolidation upstream that shrinks the universe and rationalizes the number of companies that are out there publicly trading.
Thanks for that, Greg. And as you and Parag mentioned in your review, the asset class continues to march on, having another, great quarter. Performance for midstream indices are now close to 20% up year to date. So given the recent strength so far this year and even really post-COVID, is there any sense that space has run too far too fast?
Well, it's, trying to lay out the argument for valuation. I mean, it's had a good move, certainly. Perhaps, you get a sideways move or a pullback anytime. But honestly, we kind of talked about, the base case for our space being a combination of the dividend yield, which is, 5.7%, and dividend growth of 5%. Plus we're getting about 1% share buyback. So that's kind of your base case, baseline return, 11, 12%. We've seen some multiple expansion this year to kind of recover some of the discount that we frankly got from COVID. So we're still 20% undervalued relative to 10-year averages. So there's potential expansion there, but doesn't necessarily have to happen. Consolidation has been a factor. Companies like, E-Train got acquired at a premium, and certainly New started as well. So there's been some additional benefit from consolidation. That's probably not over yet. So you typically get, some consolidation in any market, and that wouldn't surprise us. But the financial health is so strong today that we think is pretty visible to many investors today. And it's hard to argue with, strong dividend growth and low leverage and having that free cash flow to return to shareholders. That gives people confidence in the space, and that helps to improve the risk metrics when volatility declines and returns stay double digit. That makes for an attractive, risk adjusted return for many investors. And that we think is what the generalists are seeing. They're looking at this saying, gosh, 5.5%, 6% yield and 5% growth, not a bad place to start. And looks like a pretty attractive sector. And many of those investors, the generalists, may be underweight energy still, overweight tech. And it's a nice way to balance out your portfolio after a pretty substantial move in the Magnificent Seven over the last 2 or 3 years.
Great, thanks, Greg. And before we wrap the call, we do have one more question at this time. And it's also something we touched on briefly during the presentation, but maybe we want to expand a little bit more on it. And that is, how can we see the sector benefiting from AI now and in the future?
I'll start on that. The bottom line is increased demand, which requires more volumes to flow through the pipeline. So, that's one of the big reasons. When we talked about the CapEx earlier on, and is there capacity that needs to be built? I mean, there will need to be some capacity that is built. We don't know the numbers yet because there's just so much fluidity in it at this point in terms of when the AI or when the data centers will come online, where they'll be, et cetera. What percentage of the power load is natural gas versus renewables, and even nuclear. We saw that Amazon, signed a big nuclear agreement. So those are just, answers we don't have yet. So is it 3 BCF a day of incremental demand, or is it 16 or 20 or what is going to remain to be seen. But yes, that's the biggest benefit, is you're just going to require more volumes, which results in more cash flow. So
Fantastic, appreciate that, Ted. And just do a quick check to see if there's been any more questions submitted. And no, I'm not seeing any more questions come through, so we can go ahead and end the call a few minutes early. I want to say thank you to our portfolio management team, Greg, Parag, and Ted. And thanks to everyone on the line for joining us today. If you have any follow-up questions, you may contact us directly at 1-800-994-0755. Thank you and have a great afternoon. That concludes the call.